crypto regulation is at a crossroads. This fall's legislative agenda could redefine U.S. oversight, and it's sparking fierce debate. As lawmakers return to Washington after the summer break, the pressure to clarify and reform the regulatory framework around digital assets could not be greater. For over 10 years, the U.S. crypto market has suffered from a chaotic patchwork of conflicting jurisdictional claims and intense legal clashes between regulators and crypto companies. But here's where it gets controversial. The latest legislative proposals aim to redraw the boundaries of who holds the reins, potentially shifting significant authority from the SEC to the CFTC. One of the most prominent efforts, the Clarity Act, threatens to transform the crypto regulatory landscape by sharply reducing the Securities and Exchange Commission's SEC reach, while amplifying the Commodity Futures Trading Commission's CFTC role. It introduces a clear-cut classification system for digital assets, accompanied by new registration and disclosure rules designed to eliminate long-standing confusion for asset issuers, intermediaries, and investors alike. Labor Day doesn't just symbolize the end of summer. It also marks a critical moment as Congress comes back into session, and the crypto sector is front and center. Despite the industry's explosive growth and innovation, regulation has historically been a tug-of-war, with no single agency wielding clear control, leading to uncertainty that has slowed progress. The current administration's relatively positive stance on cryptocurrencies has only intensified the urgency for lawmakers to act decisively, building on previous momentum seen in measures like the Genius Act. The recent passage of the Clarity Act by the House during Crypto Week in July reflects a bipartisan desire to create a more logical and innovation-friendly rulebook for digital assets. This legislation distinctly narrows the SEC's sprawling claims by recognizing the CFTC as the more suitable regulator for many decentralized tokens, treating them primarily as commodities rather than securities. But don't overlook the Senate Banking Committee's competing proposal, the Responsible Financial Innovation Act, RFIA, which proposes a more robust role for the SEC. This head-to-head presents a fundamental question. Should the future of crypto oversight lean towards the SEC's established securities framework or embrace the CFTC's commodity-focused approach? The outcome could steer the trajectory of crypto regulation and innovation for decades to come. Digging deeper into the Clarity Act's blueprint, at its core, the Clarity Act implicitly challenges the SEC's expansive regulatory ambitions by creating three distinct buckets for digital assets: digital commodities, investment contract assets, and approved payment stablecoins. This tripartite classification assigns regulatory authority strategically among the SEC, CFTC, and banking regulators, aiming to establish a balanced and transparent structure. Digital commodities, for example, are tokens whose value is directly tied to blockchain network functionality. These are neither securities nor derivatives and fall squarely under CFTC oversight. Investment contract assets, meanwhile, represent tokens initially sold as securities for fundraising, but may later evolve into commodities once freely traded on secondary markets, a mechanism designed to reflect their real-world trading dynamics. Meanwhile, permitted payment stablecoins, which are stable value tokens pegged to fiat currencies, would be subject to banking regulators' supervision. This finely tuned framework strives to address the long-standing confusion that has left issuers and investors navigating a murky regulatory environment. The Act clarifies the point at which tokens transition out of security status, establishes new registration processes for intermediaries, primarily with the CFTC, and updates SEC rules to better accommodate digital assets within existing market infrastructures. For investors, it proposes enhanced transparency and consumer protections. though critics question how well those promises will hold up in practice. What this means for innovation, protection, and the custody gap. Many in the crypto industry welcome the Clarity Act as a sign of progress, particularly because the CFTC is seen as more flexible and less confrontational than the SEC. However, this optimism is tempered by concerns over the CFTC's limited experience regulating retail spot markets and its relatively underfunded infrastructure compared to the SEC. There's a genuine risk that if the CFTC is tasked with an expanded role without adequate resources, oversight quality could suffer. Furthermore, by allowing certain tokens to shed their securities label once trading commences on secondary markets, the act potentially opens the door to regulatory arbitrage. In other words, some issuers might design offerings to quickly escape the more stringent SEC rules, arguably leaving everyday investors exposed to greater risks. From a political standpoint, the situation remains fluid. Senate Banking Committee Chair Tim Scott has set an ambitious goal of finalizing a comprehensive digital asset market structure bill by the end of September. This effort may harmonize the RFIA and input from the Senate Agriculture Committee, the latter overseeing the CFTC's jurisdiction. Yet the core debate over which agency should dominate crypto oversight remains the crux of negotiations. Ultimately, digital assets have transcended their status as niche curiosities. They are becoming foundational to how payments, capital markets, and decentralized financial infrastructure operate in the future. The legislation that emerges from this fall's intense legislative wrangling will establish the legal and operational boundaries of this rapidly evolving sector for years, if not decades, setting the tone for how mainstream finance and crypto intersect. So here's the open question to you. Should regulatory oversight lean more heavily towards the SEC with its investor protection mandate, even if it means potentially stifling innovation? Or is empowering the CFTC, seen as more innovation-friendly but less experienced in retail regulation, the smarter path forward? And how do we ensure innovation doesn't come at the cost of exposing investors to unnecessary risks? Share your thoughts. This debate is just heating up, and your voice matters.